Great. Well, thank you guys so much. Thank you, Mohammed, for the time to talk a little bit about financial modeling. As Mohammed mentioned, I think this financial modeling is a huge part of a lot of our everyday lives. And I appreciate that a lot of us are at different levels in our careers, and so financial modeling can mean something different to different people at different levels. And so, I was asked to kind of prepare something more high level and more general to cater to different levels. Of course, I've done this in the past, mostly in person, but it was more on the detailed level where I would kind of walk through and build a model together with the group. So if that's something again that's wanted after this session, I would be more than happy to do that as well. So this is going to cover mostly high level general topics on how to think about company valuation and financial modeling as a whole, and then we'll go from there. So we'll okay, a little bit of background about me. I'm Alan Mardini, so I'm certified in financial modeling valuation. I started my career right out of college at Deloitte in the US. I started in audit and tax, and then quickly moved into M&A transaction services. There I focused a lot on financial due diligence and tax due diligence. So I would work on a lot of deals on the buy side and sell side. That's really where I developed my passion for financial modeling for due diligence and transaction services. I later joined Guardian Industries as on the internal M&A department. So there I was able to see from start to finish the full mergers and acquisition cycle, which is very different than the consulting side. I recently moved to Dubai here, and I joined CBRE. So now I'm on the real estate strategic advisory side. I do focus on financial modeling here as well. And I lead the financial modeling practice or the group on this side, where we focus on a lot of feasibility studies, highest and best use studies. So any developer who's looking to develop a plot of land around the area or the region, we are able to run the financials on it and advise on the best development and the best mix. That's a little bit of background about my history. So going into financial modeling best practices. Now these are by no means best practices for everyone to say. I mean, these are things that I've developed in my past that have made me a better modeler. And so I want to share with the group. They could be small but very effective things, especially when you're presenting to higher management or even to a client. These are some things that go a long way that show the effort. So some of the best practices here is at the beginning, using a cover page. Using cover page is very important, and I'll kind of go through a quick scenario of what this looks like. But this is able to separate where the work starts and where the work stops. An index tab is simple but effective. It's basically a table of contents. So the ability to have a table of contents or an index tab that shows the reader of this Excel sheet where to find certain information, especially when you have 20, 30, 50 tabs of data, sometimes hundreds. No one wants to go sift through that and try to find what they want to find. So having a table of contents, again, I will show you kind of how that looks, is very, very effective. A very, very important best practice to have is to keep inputs and outputs completely separate. So especially when you're working with big teams in these financial modeling exercises, not everyone's going to be at the same level, and not everyone's going to be very familiar with the model and how to use it. So being able to edit only certain amount of tabs or certain tabs that are required to edit is going to save a lot of time and a lot of errors. So the output tabs are completely separate, and those are just what you see in terms of, let's say, financial statements. So you have your assumptions on one tab, and then you have your outputs and your full 3-statement model on a different tab. That way, that tab can be locked completely, and nothing has to be edited or touched on that tab. It's simply an output tab. This has caused, having this mixed in different tabs has caused a lot of headache in my past, and so I think keeping them completely separate is very, very key. It's a small but very effective best practice. Another one is using a support tab. Now, what I mean by support tab, it could mean something separate from, for every different project. I've had projects where I've had a lot of raw data. So let's say you're going into a company valuation and you want to see all the historical financial statements, let's say the 3 statements historically, how they've been operating, and you want to build a forecast. Having this data dump of historical data it doesn't look good, and it just doesn't have any place in terms of how it's formatted. So having a support tab or a raw data tab that feeds into your assumptions and your output tabs is going to be very key.
Alan, I think we can't see your screen, sorry.
You cannot?
Yeah.
Nothing changed on my end.
It's showing blank on my end. I don't know whether other people can see it.
Can anyone else see my screen?
I can, he's saying. Okay, I think they can see. Okay, they can see. Okay, you can continue.
All right, thanks so much. Let me know if that ever changes, if you can't see my screen.
Yeah. And
then going to my next point, using data validation and conditional formatting to your advantage. Now, I've in my experience, I've built countless models, and data validation and conditional formatting are very important when you're thinking about who's going to be using these models. So a lot of times I've built models for clients, and they go in and want to use the assumptions tab and build their own assumptions in this. So having that easy to choose from let's say a drop-down list, or even operating on the developer tab, which I'll show you a little bit later, is going to be excuse me, very easy for them to just choose and click on which scenario they want to see or which input they want to see, and then the data will automatically populate and automatically calculate in terms of what they want to choose. So doing those is I always choose a data validation list, drop-down list, versus just typing something into a cell, because typing it in could mess up any formula. If you have extra spaces, if you have all these things, it's going to mess up the way the formula is read. So choosing from a list that's a predetermined list that you've written is much better and much cleaner and less prone to errors. So going through, there we go. So the process and how it looks like, how the best practice looks like, is inputs. So you start with your inputs and your assumptions. These should be only entered in once and very visibly recognized. So what I mean by that is that it's very obvious where the inputs are, and you only have to enter it once. Let's say you have an input assumption for revenue. You don't want to have to update that 2 or 3 different places in the model. That's only inputted in one spot, and once that's inputted, everything else that's related to this cell would be linked. It shouldn't be able to update in more than one place. It should be entered only once and very visibly recognized. Next would be the calculations. So after the input, it goes through a calculation phase, and these should be easy to follow and broken into steps. I've worked on very complex formulas in my past. I mean, what I suggest is the simpler the better. Sometimes it's necessary to work on very, very complex formulas with, I've had some that are 10 or 12 rows of just formula code. And so being able to easily follow how these formulas are written or how the calculation is being done is very important when someone picks up this model and tries to use it. And it should be broken into steps where it's very obvious to see how revenue is calculated, how the forecast is calculating revenue. So your assumptions for revenue growth or for cost of goods sold, those are easy to follow after your inputs. And then you go into your outputs. And these outputs should be easy to access. And like I mentioned, automatically updated. So once you've changed an input on the input sheet, everything on your output sheet should be completely linked and automatically generated. These are time savers, and again, I mean, just changing in one side and having one tab to input is going to be a game changer. And lastly, transferable to a different platform like PowerPoint. So a lot of times in my models I've done, I've had tabs that are basically called PPT ready. So they're just easily extractable. So let's say you want a summary of your, like a waterfall summary, which I'll show you, which will be linked straight to, your revenue and it goes down to your gross profit and at the end for your net profit. Having those linked and in the format that you want to extract it straight to PowerPoint, that way once it's updated and once it's edited, everything will be copy paste straight to PowerPoint, and you have no hassle doing that. So continuing on to best practices, there's different ways to build financial models, and this really depends on your goal and the time that you have to spend on working on assumptions and how detailed you want to go. So there's, on the one side of the spectrum, a simple model. The pros here can be, this simple model is basic and it's easy to follow and it does the job. I mean, it's exactly what you want to do and what you want to see. And if it's something that it's simple for, depending on, what decision you want to make, then this works. The con part about this is it lacks in precision. So it's not too detailed. You don't spend time. Maybe you have, 6 line items instead of 14 or 15 or 20. So, you're not able to dig into the details as much as you would want to, and it's too simplified. Maybe it has just one line for revenue, one line for expenses, let's say, and so on and so forth. So it could be effective, but the cons are that it won't give you a detailed look. The next, the other side of the spectrum is a complex model. Comparatively, the pros here are that it's pretty detailed and it's much more precise. So as I mentioned, it could be many more line items that delve into the detail that you want to see to be able to make a decision. The cons are, of course, it's much more difficult to model. It takes a lot more time and it's more prone to error. So if you have the time to go in and get the data that you want in the format that you want and being able to project those and forecast those numbers in the detail that you have, then great. It is more prone to error because the more detail you go into something, the easier it is to make a mistake or to model it in the wrong way. So it is more prone to error in that way. So I think the best model would be a good mix of both, where you keep things as simple as possible, exactly what you want to see, but trying to provide enough detail. And again, this could be something specific to what you want to see. It ranges from project to project and company to company. The next slide that I want to show, or section that I want to present, is making effective business decisions, and really this comes down to making a decision when you're talking about company valuation, and this is something that's related to a discounted cash flow method. So this is something that I was asked to talk a little bit about. So there are many different reasons to value a company. It could be where you're selling a business. Maybe it's a sort of venture capitalist where you're looking to raise funds for a specific, let's say, startup or a company that's looking for funding. It could be restructuring for bankruptcy reasons. It could be acquiring a business, maybe an M&A type role. Internal business decision making. This is the most that I see, where a client would come to us and say, "Hey, I'm trying to figure out, what our company is worth and how to put a number or a value on our company for any reason that they want." And so that's where the financial modeling really comes into play and helps make a decision. And of course, an IPO, going through initial public offering, is going to be one of the biggest reasons to do a company valuation. So in my eyes, I mean, I think a company valuation process, and this is something that I've learned in my studies and in kind of the certifications that I got, and how really in experience, is first you analyze the financial history of the business. What that means is, that can include different ratios depending on what you're looking at. It could be on the balance sheets, or on the P&L, or the cash flows. I mean, it could be different financial ratios and metrics that you want to look at. So you start by analyzing the history of the business, the historical numbers. Next, you would forecast the future of the business, where we project revenues, profitability, and cash flows of the future. This where really comes into the discretion of the person doing the modeling, right? You can go through different methods of forecasting, which we may cover a little bit later, but it really depends on what you're comfortable putting in those forecast numbers. Next is to analyze the industry. Here, it's a very important point where you have to understand what is the nature of the competition in the industry as a whole. If you're looking to value PepsiCo, right, you need to also understand who are the big players in the game. You look at Coca-Cola, look at any other company that's potentially a threat, or potentially in competition with this specific company that you're valuing, and you have to analyze that industry. A lot of times what I see here is a SWOT analysis. You look at the strengths, the weaknesses, then opportunities and threats in this specific industry. And lastly, analyze the macroeconomic environment. So when you think about what is happening in the market, in this specific industry, what is happening with interest rates, what is happening with foreign exchange rates, that's something that's very important when you want to look at valuing a company. And just going back real quick, I wanted to show a quick example of what I meant by the best practices here. So if you don't mind, I'm going to quickly switch to Excel to kind of show. Can you guys see my screen right now in terms of Excel when I switch?
Yes, we can see.
Great. So something I put together very, very quickly. I mentioned to Muhammad before that all the models that I've built in my past are related to, they were done for a specific reason and related to a company I was working for. So those are things I cannot show for confidentiality purposes. But to the extent that that's building a specific DCF is something everyone is interested in, I mentioned to Muhammad that I can set up a DCF model and we can build one together, whether it's in person or online like this. I've done both in the past, and if that's something that you want to have done, great. But for this purposes, it's just really to show you what I meant by the best practices, and I'll show you what I mean going through this. So if you picked up a model like this, this is what the cover page would look like. So it could be a company logo. I just use ours for this purpose, but what I've done in the past is I've used the company logo here, a quick introduction, and after that, next tab here would be like the table of contents I was showing you. So, the title is financial modeling, right? You go into assumptions. If you want to go into assumptions, you click straight here, go into assumptions, and it takes you to A1. And each tab here has a path back to where the index is. So it's like you open up a PDF or a book, or let's say, and you click on one, you click here, and then you go straight back if you want to go back to the index tab, and you choose exactly what you want to see, and you don't have to go through every tab personally to see, where's the information that I want. So this is very, very effective building this, because it shows the reader of the financial model to say, all right, where exactly do I want to go? Do I want to skip all these assumptions and go straight to the waterfall, go straight to the three-statement model? Where exactly do I want to be? So this takes the time out of looking through what you want to see. So that's an index tab. And so if we go to the assumptions tab, we'll have our assumptions tab here for our scenarios, right? Let's say here's our scenarios, and you're able to ungroup and see this. Another best practice is grouping. If I go to my three-statement model, I have everything grouped and everything laid out like this. So it's very clean, very easy to read, very easy to see. If I want to look at the income statement, I can just pop open the income statement. If I want to look at the balance sheet, I can pop open the balance sheet. So starting with this, so if we built, let's say, this three-statement model, one of the key takeaways is, your assumptions and your outputs are completely separate. You go in here and you say, all right, my scenario one, my first scenario, I want to have revenue growth at 10%, steady. Cost of goods sold as a percent of revenue. These are my percentages that I want to see. And you go down your three statements and say, all right, exactly what do I want to change here? So a lot of times when we give models, let's say, to a client, and they want to be able to, their biggest thing is, I want to be able to edit the assumptions however I please. Okay, great. If I had the assumptions mixed into my outputs here, then they would have to go in and look for where exactly and trace where are my assumptions coming from and where is this going. If this is linked to somewhere, where do I change it? And so having the assumptions completely separate is very important. So anyone can go in here and say, all right, instead of 42%, I think this should start at 45 and go up. And so once it's changed here, everything is linked. So in this case, we just have two scenarios and the live scenario here. So the live scenario is exactly what we've chosen out of these two scenarios to be. So what it does is, if you choose scenario one here, this is what it would populate. But let's say you choose scenario two, right? Everything changes in terms of what your assumptions that you have for scenario two is. Go back to scenario one, you show, all right, this is what it would look like under the scenario one. And this is a simple choose function. And here you just choose which one you want as scenario one and scenario two. And it would respectively take the percentage that you choose to tell. So in our first scenario, it would be the 10% increase in revenue, and the second scenario would be the 5%. So going through this, I mean, it's really important to keep it, like I mentioned, separate and clean, where you see your actuals and your historical data and your forecast here. And so everything in blue is an input, right? Everything here. But usually what it is that all of these are inputs that you would come in and copy and paste inputs in for the historical data. Here I had my historical data in the support tab. And so that's what I mean by when you're having a support tab or a raw data tab, where let's say you get this dump from a client or from online where you're looking at financial statements and it's in this weird format, then you can have this as a support tab and have it linked to where your outputs or assumptions are. It goes through all the way, right? Even in your balance sheet and even in your cash flow statement. So you can easily see, right? These are my historical years. These are my forecast years. And you would go in through and you'd say, okay, these don't look like numbers that are accurate. Fine, we can find more accurate data, come in and copy and paste it here, but all your formulas are already set to take exactly what you want to take as your assumption. So this is how the best practices come in. And then the waterfall, kind of like a PPT ready slide, would be the following. So let's say your revenues and you have the data you want to show here on the side, and this could be on a separate tab completely, but this is straight ready to copy and paste into a PowerPoint. And depending on how these change, right, if this becomes 500,000 instead, right, everything should automatically populate and it would change right away. So all you have to do is come in here, copy and paste this straight into PowerPoint, and it's ready. So the waterfall is very easy chart to do. It's something that I use a lot in my analysis. It's as simple as just inserting a chart. You can go to the charts here, and it's a waterfall chart here. And once you insert the waterfall chart, it won't know which ones to read as a total. So you can just go in here and select which bar you want to be the total. So this gross profit is actually the total. So if you want to change this to be the total, you can set this as total and it will go back down. That's exactly how this waterfall works, and you can have this ready straight to take into PowerPoint. Then we can go back into our PowerPoint right here. So make effective decisions. So going through the process of company evaluation now, going back here to about different valuation methods. There are a lot of different valuation methods really, but three approaches that come to mind that I've had experience with when you want to value a business. There's the cost approach. So the cost approach is useful depending on the industry you're in. It's sort of like an opportunity cost, where you want to decide if you want to buy a company or buy a business that has a manufacturing facility. You know, how much was invested in this building or in this facility? What was the total cost? Or does it make more sense for me to just, you know, set one up or put in the cost myself and do it on my own? So it's really like an opportunity cost to say, all right, this is something that I think would be more beneficial if I can invest in, or that's something I think I'm going to do myself. If the cost to build was too long ago, and the inflation and changes in technology may mean that the replacement cost is much different than the cost to build. So this is where you analyze those two. The market approach takes into consideration two different variables. Here we look at what other companies are worth and use them as a proxy to value our company. The comparable companies, this is usually for publicly traded companies where information is readily available. You can determine what other investors are willing to pay for that company. You look at, like I mentioned, let's say PepsiCo and Coca-Cola. If you're looking to value one of those companies, you look at what has other companies' share price been and what have they been valued at, and you kind of understand where your company would be valued in relation to that. The precedent transactions are past M&A deals. There's a lot of data that I've seen publicly for public companies that show past M&A or transaction values. Here we can see how much an acquiring company paid for a business. And a company came in and wanted to make a bid for a specific company that's similar to yours. You can come and see exactly what the asking price was and what the transaction value is. So these two comparable and precedent transaction methods can provide a very good overview of what a company might be worth in relation to other companies. And then the most common and most asked about method is the DCF, the discounted cash flow. The discounted cash flow, we look at this company that you're valuing in isolation. So we don't look at what other companies are worth. We don't look at what it costs to build in the cost approach. We look exactly at the ability to generate revenue for a specific company. So we forecast the future performance of the business, usually up to around approximately 5 years, and then we assume a sale of the company or a perpetual growth to give us a terminal value. And then after that, these forecasted cash flows will be discounted back to today using a discounted rate. Usually it's a weighted average cost of capital, which will then give us the net present value. So this is really what the DCF looks like. And there's a very high level of what the DCF looks like in the steps that I'll go through in a little bit. But when you're thinking about building a discounted cash flow or looking at a discounted cash flow, there's a lot of in my head a lot of problems that come to mind. One of them is that I've seen and I've got questions about is, okay, how can we forecast the cash flows of a company with certainty, right? Because one, we don't know how long the company will be around for. So you can forecast it for 5 or 10 years, but really, how long do you know? How long is this company going to be around for? So how can we accurately forecast the number of years? And number two, forecasting is only an estimation. You can put in any number that you want or any percentage that you want, but how do you know that this is an accurate estimation? So I think the mix of these two items where you you use a forecasted period of up to 5 years, and you use a terminal value. Those kind of mitigate these questions and say, you know, all right, we're not going to forecast it for too long, right? We're not going to have a forecast for 20 or 30 or 50 years. We'll forecast it for up to 5 years using the historical percentages as a trend. If you see the revenues rising at 3% per year, year over year, then you can make a pretty good educated guess as to what the estimation will be for the next 5 years, right? We use the 5 years as a good base to forecast, and we use the terminal value as the question of, all right, how long is this company going to be around for, or you know, how can we go about this forecasting as just an estimation? So there's two different approaches to the terminal value, which I'll go through in the next couple of slides. So just a very quick overview of building a DCF model. Like I mentioned, the discounted cash flow is a model that estimates a business's intrinsic value. What that means is it's the intrinsic value of the company. That means it's just the internal value of it. So forecasting your internal cash flows. So being able to understand how efficiently this company generates cash flows year over year, versus, you know, looking at other companies of what they've been sold and the preceding transactions that we saw. So this is intrinsic value of a specific company internal. By forecasting its cash flows and discounting them back to reach a present value. There are two common ways to calculate cash flows. The first one is unlevered. Unlevered, sometimes they call it free cash flows to the firm, which is most commonly used. This is a measure of cash flows that is available to all investors for both debt and equity, right? So this is what we call the enterprise value. The enterprise value is, at the end of the day, cash available to any investor out there. It starts off with EBIT, and we work our way down, applying the tax rate that you get to the NOPAT, they call it, and you add back any non-cash expenses. We add back items like depreciation, amortization, because they're non-cash items, meaning while they do lower net income when you put them on the income statement, they do lower the net income, but they don't have effect on the amount of cash on hand. So they're basically added back because this isn't really cash that we're losing. As an investor, it's not cash that you have put in and you're not getting back. It's a non-cash item. And then you deduct net working capital. So here you deduct net working capital. You know, net working capital is calculated as, it's a pretty detailed calculation, but the simple calculation is basically difference in current assets and current liabilities. So if current assets are rising, the company is investing money in assets like inventory and PP&E. So these are cash expenses that are not captured on the income statement, or, you know, in operating expenses. So if current liabilities are rising, then the company is, you know, gaining cash in the sense that it's not yet paid any of its the debt that they will have to pay in the future. So this could be like wages payable or something that increases on the liability account. And then you deduct cash expenditures. The reason being is that, you know, the CapEx is deducted because it's actual cash that's invested or spent to purchase PP&E or inventory, which we're essentially reversing everything the accountants did. So the accountants are, you know, accounting for depreciation, amortization, and then we're adding it back and we're removing any cash spent. So this comes up to the unlevered cash flow. The levered cash flows on the other side is very similar, but it's only in relation to the equity value. So if you have an investor that has invested in equity and not debt, this is where your cash flows differ. So this is called the equity value. So it's a very similar calculation, except here you're also deducting any debt payments that you're accounting for when you get down to the levered free cash flows. And your net operating income here already captures the interest expense. So steps to building a DCF, and this is high-level steps. And again, if this is something that is interested, everyone's interested in the future, we can delve deep into this. But there's a lot that goes into thinking about a discounted cash flow. To calculate a terminal value. There's a perpetual growth rate where the free cash flows are assumed to grow at a small rate indefinitely, call it 1, 2, or 3%. You can have that as a terminal value where you can have it at perpetual growth rate at a really low rate, or a low percentage. The other one is an exit multiple approach where the business is assumed to be sold at a valuation multiple that is close to the valuations that are in the current market. So sometimes you see 5x EBITDA, 6x EBITDA. Those multiples are very important when it comes down to what do you think is the right amount to be categorized as a terminal value. A lot of times in your net present value, when you're trying to value a company, 50%, if not more, of your value comes from the terminal value, right? You're forecasting for 5 years, and you put a terminal value at the end, and a lot of your value is going to be in that terminal value. So it's really important to choose what you think is the right approach to calculating a terminal value. At some point, you have to make a higher level assumption about the cash flows beyond those 5 years. So that lump sum is called a terminal value. And then discounting the cash flows to the present using a weighted average cost of capital. The discount rate that reflects the riskiness, the risk of this company or this project that you're working on is called this weighted average cost of capital, because the unlevered free cash flows represent all of the operating cash flows. These cash flows belong to the companies, you call it investors or owners or lenders. Because of that, the risks of both providers, any provider of capital, needs to be accounted for using the appropriate structure. So there's a whole a whole calculation that can be done in terms of going into this weighted average cost of capital. A lot of times, what we've done to calculate cost of equity is to understand the risk premiums. So if I go here real quick to my Excel, sometimes on the projects that we use to calculate this cost of equity is use something like this. So if you can see here, so depending on the country, this cost of equity will change. But we use a risk-free rate. That's usually the long-term U.S. Treasury rate. A country risk premium, depending on the country, equity risk premium, industry risk premium, and a company risk premium. Really, these two items here are plug figures to be able to understand really what the risk is working on a specific company valuation or in a specific industry. If an investor is really not comfortable investing in something new, so if they've been in the manufacturing industry for the longest time and now they want to get into the tech game, right? Looking into purchasing or acquiring a tech company is going to be pretty risky for them. They're not going to understand all the nuances that go into operating a tech company. So there may be put in a higher industry risk premium and a higher company risk premium. So we've used some of this in the past where we want to calculate the cost of equity, but going into the cost of weighted average cost of capital calculation is a whole different calculation to do. So that really depends on what you're comfortable with going forward. And then at the end is subtracting any debt and other non-equity claims. So the ultimate goal is for the DCFs to get what belongs to the equity owners, right? The equity value, like we talked about, the levered cash flows. So therefore, a company has these investors that they need debt to be paid back. So you have to deduct any debt payment to be able to come down to what this real value of the company would be worth. So often what happens as well in this bucket, they sometimes add back any non-operating assets. Non-operating assets like cash or anything that's an investment that's sitting on the balance sheet, they would be plugged into here where you would add back any non-operating expenses and then subtract any debt or non-equity items. Some key assumptions to be careful about and to really understand is first the operating assumptions. Like I mentioned, I mean, you going through the forecasting percentages to say, all right, revenue will probably grow at this rate for the next few years. Cost of goods sold, any inventory or accounts payable, accounts receivable, those operating assumptions are very important. And any change in these operating assumptions will have a completely different value to your company. So understanding and making sure that you know that these assumptions that you're putting in are accurate and you're comfortable with. Calculating the weighted average cost of capital is also very important. I mean, this is going to be the biggest factor when you're thinking about the net present value, right? You take into consideration your WACC, and this is what's going to have it can make or break a company valuation for you. So understanding how the WACC is calculated and coming out to a percentage you feel is right is going to be a big player in this game. And then, of course, like I mentioned, the terminal value. The terminal value is at least 50%, sometimes more, of your value of the net present value of a company. So a small, slight change in your terminal value, if it's 4x EBITDA versus 6x EBITDA, this is going to be a really big difference in your final number. And so understanding the terminal value and how it's calculated and being comfortable with that is going to be one of the most important assumptions you're going to have to make. Going to the latest trends, this is something that I just want to cover very briefly, latest trends in financial modeling. So I was recently exposed to different platforms for data visualization or dashboards. So what I'm used to doing is creating these data dashboards in Excel, and that takes a lot of time and it's prone to error because it's all driven by this data that you have, and you're trying to make these graphs and charts to look good. It's very effective in Excel, but what I've seen using different platforms like Power BI is very effective. So the ability to couple Excel with Power BI is something unmatched and something that I have been looking into to change the way we do visualization for how we do it right now, because this is something that, you know, the Power BI is able to store a lot more data than Excel on its own. So, you know, if you're able to store, you know, thousands of rows of data in Excel, Power BI has double, triple that amount. I mean, it's endless because it stores data on the cloud. So you don't have to go through the hassle of having your Excel crash like I do almost every day, and taking forever for things to load. This has the ability to easily import data straight from Excel into Power BI, and you can manipulate this data in whichever way you want to be able to tell the story you want to tell. This is something that's going to be, you know, if not already, it's taken over, but it's going to take over in terms of data visualization, because it has the ability to identify trends in the data, to show exactly where you have a missing gap, and you can fix it. So instead of going through and saying, why is this number not coming out, and you have to go through in Excel and backtrack and find the source of the error, here it shows you exactly where, you know, it would mark something in red or green where it show, hey, this doesn't make sense, there's a bit of a gap here, so look into it. It lowers the risk of manual error, and it takes minutes to be able to present data visualization and dashboards versus, you know, something that could take hours in Excel. So this is something that I have been looking into changing how we do things, like I mentioned, not just using Excel, but you should couple it with a platform that would allow you to do this much easier, much quicker, and the way you want to be able to present to management or executives or clients. So Power BI is a really good tool. There's a lot of things out there, like something I was looking into as well, Ultrex and Tableau also. There's a lot of things out there, but Power BI is something that I have a little bit of experience with in the past, and this is something that I think is going to be a big trend in financial modeling in the past. Now, you can't build, from what I understand, it's not something that you can sit and build a financial model on. You still need Excel for that. But to be able to present things visually, this is going to be a big game changer. So this is all that I had to, quickly touch on in my short period here. Again, I was kind of asked to do something in relation to kind of cater to all different levels, and so I wanted something a little bit more general, a little bit more what I thought would be best practices and kind of things to think about when making a decision. Like I mentioned, I've gone through detailed discounted cash flows before with different groups, and if that's something that's the group is interested in, please let me know, because I'll be able to do that, and we can do like in a session on fully in Excel versus something that's a hybrid of PowerPoint and Excel. But I just wanted to kind of introduce you to what I've seen in my past and my experience, and just share things that I wish someone had shared with me in my experience, and hopefully this could help save a little bit of time for you. I have a lot of cool kind of tricks. Actually, I want to show one thing I had mentioned to you using the developer tab, if you guys have a minute. There's something that I call database modeling. This is something I use for a client. So the data I have in here is very sensitive, so it's not something I'm gonna really show, but I want to show you kind of how to make sense of data or analyze this data, and using specific formulas or the developer tab if you haven't used that in the past. So again, I have my index tab here where I can go straight to the flexible summary, flexible summary 2. If you go to flexible summary 1 here, so if you have, so in these in these data tabs here, right, you have data tab 1, 2, 3, 4, 5. All of these grouped data here has all the data that you would need, right? And I'm not going to open it now because of the sensitivity of this data. But if you wanted to be able to summarize it into this, so you have cost category 1, cost category 2, 3, 4, and 5, and you have the different areas you want to show, right? Call it different Emirates in the UAE. So being able to choose if it's industrial or if you want services or trading or general trading, right? Using this developer tab is very effective when you're presenting, especially to high level management. If someone picks this up and just wants to say, all right, I just want to see what's going on in the trading industry, it automatically populates here, right? This takes straight from the tabs that are written. So if you see the formula here, this shows this indirect formula is a lifesaver. This is something I encourage everyone to use. This indirect formula has its pros and cons, of course, but the pro is that it can search any tab in the Excel in your Excel model and return a specific cell, right? So here again, one of the best practices that I've done is I use these formulas, but I hide anything that I don't need to show. So what it does is it picks up, it looks for where is the tab name data 1. So there's a data 1 tab. It looks for the data 1 tab, and it gives me a specific cell, D51. Or it shows me, hey, I want to be able to add or subtract or whatever different cells, and it will give you this category back here. So this cost. So choosing here the different industries, let's say, or different categories are really helpful in terms of not having to go in and say, all right, if I didn't have this, I would have to have 5 or 6 different tables that look exactly like this, to be able to have one for general trading, one for trading, one for industrial. So having one table to be able to choose here is very effective. One last quick thing, where if you're working with different sets of data in the manufacturing industry, you want to analyze location, destination of from origin into these destinations, the weight or the average of currency, or let's say dirhams or dollars that it takes to ship from one place to another, right? This flexible summary will able to show, depending on the type size, type 2, if you have a weight of 100 to 500 kilograms, and if it's going to New York or Los Angeles, it also updates according to that. Being able to present data like this and filter through all this noise, and to show someone, just to be able to come in and say, all right, all I want to do is have inputs here. So this is a data validation list, and it's just a simple index match to show exactly what you want it to do. If it takes the area and takes into consideration the different types. So these formulas are very flexible to have an index match. But if you see here, my match is actually a 2-step match. So it's matching 2 things in one bracket. So I have a lot of cool tips and tricks like this that I've done, that I've had experience in, that I would love to share with you guys, because it saved me a lot of time going through that. So I just wanted to give you a quick, snapshot of this. But feel free to reach out to me anytime. I really appreciate you giving me the time to talk a little bit about my experience and what I think about this industry. Like I mentioned, I've been in this industry for a few years now, and it's something I'm very, very passionate about, and I'm continuing to expand my passion and education on this. So if there's anything that you guys wanted to learn more about, or just talk about, or want to go through, please let me know. No problem at all. And Mohammed, I'll give it back to you now. If there's any questions or something that you wanted to ask me to prepare for another time or something, then please go ahead.
Yeah, thank you very much, Alan. I think you have given a very good overview of the entire concept of financial modeling. And of course, this is a very broad topic, and it's not possible to cover in 1-hour session. Yeah. And we are planning to arrange some further webinars, or even some workshops or seminars, on-site seminars as well. So there you can also obviously join, and then we can work on some models, and obviously some practical issues which finance professionals they face, and that financial modeling can assist them in the decision-making process. So I think that's a good session. And if anyone has any question, they can just unmute themselves and they can ask live now.
Sure. To go back to your point, Mohammed, I've done in my past workshops too. A lot of them, some with clients that have requested, but a lot of them kind of in a similar situation that we are in. With a lot of group of people. So what usually we do is kind of similar to what we've done in the summit, where we rent out a place and we go through and build something together. So it'd be a kind of like a conference room setting. I would prepare beforehand the model that we want to go through, and we build it together. So that's something that anyone's interested in, to build something together and to go through all of these tips and tricks together and how to do these formulas. Please let me know. That's something that I'm excited about. So I'd love to do that.
Yeah, exactly. And I think Alan is part of our MECA chapter, the way chapter as well. So any questions or any tips or any advice they need, they can also ask, and we will definitely arrange some workshops or some seminars. We are planning actually many events for 2020 for our Dubai chapter. So obviously financial modeling is a very important area, and it's like very important tool for finance professionals to support businesses. And just very quickly, Alan, I just want to check with ask you one question, if you can quickly share your experience on, like mostly in the financial modeling, like when we talk about financial modeling, we usually focus on the financial data mostly, like as you mentioned, sales, revenue, and cost of capital, capex or opex. Did you have any experience of working of incorporating non-financial data in financial modeling, like operational data, and how we can handle that one in the under any financial model?
Yeah, do you mean non-quantifiable data in terms of numbers?
Like anything non-financial, for example, relating to operations, for example, labor hours or number of goods sold, or anything other than financial, like non-financial.
Yes, yes. So as I mentioned, I've been in many different industries in my experience. I've built models that incorporate and not specifically financials, right? They analyze, like you mentioned, it's trends in our business. So in my previous capacity as well, I've built things that analyze, let's say, rates of performance for specific machinery and equipment.
Okay.
So I work closely with our engineers and our architects and our scientists to understand the process and build something. And this is something that Excel is very good at as well. You're able to build these things to analyze. It could be anything, anything that has data, anything that has numbers related to it. Excel is good. So I've done that in the past, and I've even done something where we analyzed geographical areas around, let's say, the Emirates, and analyzed quantifiable and non-quantifiable data. So like qualitative and quantitative data. So able to understand how easy it is to, let's say, buy an apartment or set up a business in a certain area. Analyzing those things and putting them into numbers is something I've done in the past too. So Excel is very, very good at analyzing things that you need. Yeah. So.
Okay. And one last question, as you mentioned about calculating the cost of capital or weighted average cost, and you mentioned obviously we have to include like industry risk premium and lots of other factors like risk-free rate. So for example, if we are making financial model for 5-year or 10-year for long term, so how frequently you need to update? Because like there are lots of uncertainty these days in the market, especially in UAE, Middle East market, like due to volatile market conditions or variable global economic growth, technology. So like how frequently you need to update your financial modeling? Like how frequently, like for example, if you're using rolling forecast, like to forecast future figures, so how frequently usually you recommend to update it according to market conditions?
Yeah, no, that's a good question. This really, it depends, right? My answer is really it depends, because it depends on exactly what your goal or your objective for this model is, right? And I think if you ask different people, they'll say different things. But I've seen experiences and sometimes that they've updated it quarterly. Sometimes they've updated it quarterly. Sometimes it's monthly. Sometimes it's just twice a year. Sometimes every year.
Okay.
It really depends on the users of the financial model. But I've been in a position where I've been updating a financial model almost every month for a client, because the data that they were working with is very volatile and it changes really quickly. So if it's something like a forecast that you put in for the next 5 years and doesn't really change often, I wouldn't really change it too often. But I've had experiences where, it was almost monthly or quarterly that I would have to update, because the information and the data that they're requesting is it changes all the time, right? If you're looking at the prices of gold, let's say, from the beginning of the day to the end of the day, it's a different price. So it really depends. It's something that you can even go into update daily. So it really depends on the objective of your model and the data, the accuracy and the timeliness of the data that you have.
Yeah, that's right. Okay, it's clear now, I think. And mostly people, I think, in the chat box, they're asking if you can share the slides with them.
Sure.
Okay. And I think that's all. I think I can't see any questions. So if they have any question, obviously they can ask on our WhatsApp group as well.